with the S&P 500 being up 14% year to date, I'm getting a lot of questions if everything is overvalued, if there's no more opportunities left in the stock market. And I personally disagree with that. I'm seeing so many opportunities, it's not even funny. I'm going to share two of them today. One of them is a growth company, which I like very much, and I think it's presenting a really good setup relative to other stocks. The second one is more of a mega cap quality company that I believe is also presenting the best setup amongst the big seven and amongst large cap stocks in general. So I really hope you enjoy it as always. The first stock, which I haven't talked about in a while, is SoFi. SoFi is down 7% over the last 5 days. We've had an amazing year so far for the company. The stock is up 82% since I've been talking about it, the $13, $14 range. But I bought the stock at 14 in February. After I bought it, it went down 45% to $8. I bought the dip. Then I recently averaged up at $21 on August 20th. So stock went down as low as 21, and I did buy the dip on August 20th, and now it's sitting at 25, and I might even average up at $25 because I believe the stock is just extremely undervalued relative to the potential. And it's not just about the stock going up 82%, but the fundamentals have also improved a lot. And earnings per share should be up 150% going into 2026. And I'm going to explain why. But for SoFi, again, a lot of people, they cannot believe they're late. And many of my group members told me if we should sell the stock or if it's too late. But if you really look at those stocks like Palantir and Robinhood, most of those stocks, they make their biggest move after they break their initial high. So whenever they go public in 2021, 2022, the stock goes down, it forms a base for 2.5 or 3 years, and then it starts going up. But the big move tends to happen once it breaks its initial high. And this is what happened with Palantir, it happened with Robinhood, and it could potentially happen with SoFi, especially if the fundamentals are there to support it. But for SoFi, again, it's a digital bank, as you could say. They have credit cards, banking, SoFi Invest kind of products, loans, student loans, home loans, personal loans, everything you could want. The company has an 11.7 million user base, so 11.7 million members are SoFi members, and this is not even 5% of their total potential. The adult population in the United States is 220 million people, and have 11.7 million of them signed up on the SoFi platform. So the TAM is huge for SoFi. Revenues have been accelerating to 44% year-on-year growth. Adjusted EBITDA margin is now 29%. So EBITDA margin is also increasing in a major way. Net income margin is now 11%. The company was unprofitable 2 years ago, and now it has an 11% margin. And I think it could have a 25 to 30% net income margin 3 to 5 years from now. Now for SoFi, there's three main bets or three main tailwinds with SoFi that I believe most of them are not actually priced in. But the first one is, if you're betting on SoFi, you're mainly betting on the fee-based revenue, which is 44%, eventually becoming 80 or 90% of total revenues. Now, prior to 2023 or maybe 2022, whenever you go on the SoFi website and you apply for a personal loan, SoFi would approve you for the personal loan and they would hold it on their balance sheet. So if you don't pay the loan, SoFi is responsible for you not paying, and that could be in major, major trouble. They would be taking a lot of risk. But over the last 2 years, SoFi has implemented a different model where SoFi does not hold the loan on the balance sheet. A third-party lender holds the loan on their balance sheet, and SoFi is more of a middleman where they're not taking the credit risk. If you don't pay, SoFi is not going to be affected. SoFi collects origination fee for hooking you to the third-party lender, and they also get servicing fee whenever you make your payments on the SoFi platform. So this is a much higher recurring revenue, higher margin business model. Now it's 44% of revenues, and eventually it's going to be 80 to 90% of revenues, which will give SoFi a much higher net income margin Now it's 11% with only 44% being fee-based. Now, if it's 80 or 90%, the net income margin could be 25-30%, and the stock could warrant a multiple expansion. Something else that could come on SoFi, which is a major tailwind, is SoFi is getting back into crypto. And now a lot of people don't just want to trade in and out of crypto, but they actually want to hold crypto for the long term. They want an asset allocation in Bitcoin or Ethereum as part of their long-term portfolio. And a lot of investors on the SoFi platforms, they're not traders. Most of the traders are on Robinhood and Webull. So SoFi mostly has long-term investors or investors investing or saving for retirement. And now it's becoming more popular to hold some Bitcoin or Ethereum as part of an overall portfolio. And SoFi could potentially benefit from that. And it could be huge for the company, maybe not as huge as Robinhood because there are not many traders on the SoFi platform, but it could still be something major in my opinion, which is going to boost revenues in a major way. And this is going to come up very soon. There's a wait list on it, and I'm very excited to see that. The last one is potentially the housing market picking back up and coming back to life as the Fed is cutting interest rates, and we could potentially have lower mortgage rates, which it could encourage refinances. And SoFi does have a major presence in terms of origination, in home loan origination, refinancing, and providing loans. And they actually been increasing their origination volumes despite interest rates not coming down in a major way. This is because the company is going larger, but now they're almost back to their 2021 volume because the company is growing larger. Now imagine what's going to happen whenever the mortgage rates go back to maybe 5%, 5.5% on the 30-year. It could be, a major boost, a major tailwind for the company, which is why I always say that SoFi is also a housing bet, an indirect housing bet, but that could be a major tailwind that's not priced in the estimates and it's not priced in the stock at all. Now, for my upside potential, I'm using the latest quarterly earnings call where the company said, or maybe the CEO said, he said, we continue to expect to exceed 25% compounded annual revenue growth from 2023 to 2026, and we really remain confident in delivering our earnings per share target of 55 cents to 80 cents in 2026. And this is what I'm using. And if you look at SoFi's record, they always have a good record of setting low expectations and beating. So the CEO, for example, he started the year with like 23 cents in earnings per share for 2025. Now the guidance is 32 cents, and we're not even in Q3 yet. So this is the history of SoFi. This is what the CEO does. So if he's saying 55 to 80 cents, it will likely be closer to 80 cents. And he expects 20 to 25% earnings per share growth beyond 2026. So this is what I put in my estimates. I got the 32 cents, which is what's expected for 2025. Then I put in 80 cents for 2026, which is the higher end, which would be 150% growth. It might seem impossible, but again, the company just turned profitable. So whenever you have such low net income margins, it's very easy to grow earnings per share in a major way. They could have done that in 2025, but the CEO mentioned that they are reinvesting in research and development to bring back crypto and invest for growth, which is why they artificially lowered earnings per share growth this year in 2025, and 2026 should be a major year in terms of earnings per share growth, and Robinhood is growing 100%. So SoFi is expecting up to 150% in 2026. Then I put in 25% in 2027, 20%, 20%, 20%. The current PE ratio is 61 times earnings. 61 times might be too high. I'm using a 40 PE. And I know many of you guys have been telling me that you disagree with my 40 PE target, that you believe 40 PE is too high. But you have to imagine the company 5 years from now. Yes, it could be growing less, but if their fee revenue is 80 or 90%, then the company is going to be much safer, much less riskier because they don't hold the loans on their balance sheet. They're going to have much higher net income margins, potentially 25, 30%. So it does warrant a higher multiple than a company like JP Morgan, which isn't growing and it's not as efficient as a company like SoFi. So I believe 40 PE is very fair. Taking a multiple contraction from 61 PE, I would get $69.12 12 cents in earnings per share, which is 168% on the upside, or 21.8% return or annual CAGR over the next 5 years. So I believe this is an amazing return for a company like SoFi. I think $25 is not as expensive as people believe, but people believe it's expensive because the stock is up. But whenever the stock is down, there's also all kind of reasons of why we shouldn't buy it. Like when I was talking about it at $14, I was told that Robinhood's gonna kill them. So there's always a reason when the stock is going down. But whenever it's going up, people again skip it because the stock's going up. But no one looks at the fundamentals and the potential upside. So for me, I averaged up at $21 on August 20th. And if we get another dip, if it keeps going lower, I might potentially buy a little bit more. But I still believe SoFi looks good over here. The second one is Amazon. Amazon is the only one of the big seven that has been disappointing, unfortunately. And I do own it in my portfolio. And I've been saying that Amazon is my favorite. And so far, it hasn't been playing out too well. Every single stock has pretty much outperformed Amazon, but Amazon is getting too cheap. It's trading at 14 times price to operating cash flow. 14 times for a mega cap like Amazon is pretty crazy in my opinion. And Amazon, I talked about it many times, and I'm not going to waste your time on the company, but they have a lot of different businesses and they have a very deep moat, and they have their foot in everything from healthcare to retail to everything you could imagine. Amazon is in it, and it's pretty amazing. Now, some things that that's really dragging on the stock, in my opinion, is Amazon Web Services, because Amazon Web Services is growing. As you can see, it's pretty good growth year on year, around 22% CAGR. But if you compare it to Microsoft Azure or Google Cloud, they're growing much faster than Amazon Web Services. Now, they're also much smaller than Amazon Web Services, which means, of course, they're going to be growing faster. But still, Amazon Web Services has been lagging. But there's a lot of talks that this could potentially change in the future. But this is mainly because of their investment in Anthropic, which is an AI company. Now, they do own a decent stake in Anthropic, I believe around 30%. The company was recently valued at $100 billion, which means Amazon's stake is now worth $30 billion in Anthropic. And Anthropic mainly uses Amazon Web Services for their needs and their capabilities. And Barclays, they expect Anthropic to add 100 basis points to Amazon Web Services growth now, but it could hit 400 basis points per quarter once Claude 5 ramps up. Claude 5 is their own kind of version of ChatGPT 4 or 5, and have Claude 5, which is like an AI kind of agent, and it's actually very good and very efficient, and it's gonna ramp up very soon. And once it does ramp up, they expect Anthropic to add around 400 basis points of growth to Amazon Web Services. So this is another one where Amazon owns about 30% of Anthropic, and Anthropic could potentially add massive growth to Amazon Web Services on top of their other clients, which is pretty amazing. Now, one concern I had with Amazon is the deceleration in operating cash flow growth, and it has decelerated from 82% growth to around 12% by June of 2025. But I've seen a lot of things, and some of it could be due to inventories, because inventories have increased due to tariffs and other things. So this is something that I'm monitoring for the future. If it stays at 12 or 14%, I might reconsider my position. But for now, I believe it's mostly a temporary problem. Now, if you look at the growth and expected growth of operating cash flow for Amazon, the company is trading at 14 times operating cash flow, but the operating cash flow growth is expected to trough this year at 12% in 2025. It's expected to pick back up to 21%, 21%, 20%. So around 20% operating cash flow growth for the next 3 years. Now, if Amazon does grow operating cash flow by 20%, and you're only paying about 14 times price to operating cash flow, this is less than 1 time the growth of operating cash flow for Amazon. So in other words, Amazon is too cheap to ignore. it's been cheap for a while. I'm not sure for how long it's going to remain at such prices, for how long it's going to keep dragging on the market. And it's trading at a discount, in my opinion. And it's very attractive relative to other opportunities, given the fact that other stocks and every single stock has pretty much gone up except Amazon. And Amazon could potentially catch up to the big six and other stocks that have had a fantastic year so far. And it could potentially happen as soon as 2026. So I still like Amazon. I think SoFi is by far the best between the two. And I think it's presenting one of the best risk to reward in the market, despite the stock being up. And I will likely average up even more, because this is what I do with my winners. I don't sell them. I mainly average up on them whenever there's those free kind of sell-offs and I get an opportunity to do so. But that was my opinion on SoFi and Amazon. I hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.